All right, everybody. Thank you so much for joining us for our latest webinar here in our webinar series, where we're covering the foundations, your investments, and advanced planning ideas. Where hopefully you're finding some value out of this and able to you know to follow along, and if anybody ever has any questions, reach out to us. I mean, we're trying to talk about the things that we hear every day, because you're just one person out there, and oftentimes somebody else out there has concerns as well that might echo some of your concerns, and we're dealing with people in mass, oftentimes in very similar situations to yourself, and hopefully you're finding this of value and of interest. And I thought that today we would go through and answer some questions, that common questions that we've been getting over the last month or so, because I'm sure it's a question that if we're getting asked it, then you might have the same one yourself, and I think you'll find it useful today.
Yeah, and as Kenny mentioned, this is just a part of our ongoing series here that we've got. We're back to foundations. I think this is the third loop that we're doing, and for the folks who are rejoining us, we appreciate that. On the Bearfax page, you can find our prior webinars where we cover different topics related to financial planning foundations, as well as investments and advanced planning topics, as Kenny had just mentioned. So today's topics, the Q&A that we've been getting recently. There's been a lot going on, and so we've kind of plucked out three common ones. These are the abbreviated versions. When and how should I get my money invested? The second question that we see is, well, should I invest when the market seems to be at an all-time high? And then thirdly, we've got an election coming up later this year. So is now a good time to invest my money or not? So with that, let's tackle each one of these. So the first question is, I have cash that I'm sitting on, but I'm nervous about getting into the market right now. So when and how should I get that money invested? And we've got kind of a two-part answer here. The first one is going to be more straightforward, I'd say. If the money that you have sitting in cash was previously invested, say it's a rollover from an old employer plan, or for any number of other reasons, it has been invested according to whatever your strategy has been, then it should go ahead and get reinvested, all things being equal. Unless there's some significant change personally, professionally, or financially that would mean that it shouldn't be, then if it was already invested, then definitely don't try to time the market in this way and say, well, I'm going to sit on cash and I'll get it done at a better later time. Because as we know, if you've heard anything from us, that's just a loser's game. So that's part one. But part two, we could expound upon a little bit more.
Yeah. So if this money is in cash and in savings, then what do I do? Do I put it all in the, quote, the market? Do I put it in, do I average in, essentially dollar cost averaging, where you're putting in a certain amount of money every month? And this is where there's no right answer. Okay. First off, because we don't know where the market's going, right? If we know the market was only going higher from this point forward, you're obviously better putting it all in at once, because mathematically speaking, and that's what we're trying to do is look at things objectively, is that your money has higher expected rates of return every day by putting it in, quote, the market versus leaving it sitting there in cash. That being said, we obviously don't know when those returns will realize themselves. So, I mean, think about what you would be comfortable with. If you sell a business, right? And let's say that you receive $5 million from the sale of a business. And so I want to, I need this money to last. I want this money to grow. I know if I just sit it in the bank account, it's only going to depreciate in value because of inflation, which, especially with what's going on in the world today, you would expect inflation to come, sooner or later, certainly. And so the question is, well, what do I do? How do I make this decision? Because it's an extremely tough decision to make, because this is your life's work. This is what you've got. And so you got to one first is develop a plan, right? Develop a plan with the money. And it might be that I'm comfortable putting this in. And it might be that when we say putting it in, it might be 50% is in the market, or at least subject to ups and downs of the stock market. And the other 50% is in cash and fixed income, which is really not, when we talk about the market being at all-time highs, we're not really talking about the cash and fixed income, cash and bonds. We're talking about stock market. And so if you can develop a plan, and whatever that plan may be, and stick with that plan, is where you're going to put yourself in a good position. And it might be that, all right, I want to invest $100,000 a month for the next, however many months until we're all in. It might be I'm comfortable doing whatever, putting it all in today in half stocks and half bonds and just, forgetting about it. As long as you're comfortable with it, and as long as you have the discipline to stick with the plan, your result will probably be very good, especially given enough time. It's when you start to allow yourself to make emotional decisions that you entangle the emotion, incorporate the emotion into your decisions, is where it starts to become, much more dicey. And you don't know if you're going to be able to, make the best decision.
Yeah, no, I think that's a great example of, let's say, the business owner who might be coming up on a windfall here soon. Another example that we saw recently with one of our clients was just, hey, they had accumulated this cash balance in what they considered to be their emergency fund, but their emergency fund was just incredibly too big for what they actually needed for their particular situation. And so this is another good example of, well, I can tell you about how, mathematically speaking, a dollar invested today is better than a dollar invested tomorrow, but there's that real world element to it that we've got to kind of fight against while we're still trying to be objective, right? And so, as Kenny mentioned, coming up with whatever strategy or whatever plan that is, and whatever time frame that looks like, and then sticking to it, trying to strip out the emotion as much as you can, while recognizing that there is that human element to it as well. So I think these are a couple of good ways to think about this question. How should I get the money invested if I'm nervous about the market right now?
You just got to have a plan, and have a plan that you're comfortable with. And I think that leads in perfectly to the question number 2.
Yeah, right.
Should I invest when the market's at a high? All right. And I can certainly understand the concern about jumping into a market that has recovered as drastically as it has, especially, we're approaching all-time market highs again, especially when the economy and the jobs report and decline in GDP and with the pandemic and all that, not having apprehension about, wanting to put your money in. And I think that, as I said, perfectly understandable, but we look at it as advisors as it's our job to disentangle that emotion from the financial decision-making process and try to give you the information so you can make the most informed decision. And here's what the information tells us. Does the market being at an all-time high mean that the future expected return is not as good? I mean, if the answer to that is yes, then the what we do about that is we don't put the money in, right? We wait for it to decline in value. But the answer to that question is no. The market reaching an all-time high does not tell us anything about the future 12 expected return of the market. It still is extremely positive, and as evidenced by this chart right here, 12 months after the market reaching an all-time high, 81% of the time it's positive, and the average 12-month return following an all-time high is actually higher than the historical average return in general, is 14, is close to 14%.
So even at a high, 4 out of 5 times going forward, it's a new high almost, or that momentum continues to carry forward. Is that the right way of thinking of it?
Yeah, exactly. So, I mean, it continues to reach a new high. So to boil it down is as simple as I could just say is that the market reaching an all-time high has nothing to do with the future expected returns. It's an arbitrary number. Because Coke is at, whatever price per share, the executives at Coke don't think we reached our all-time high. We got to slow down and try to get, go back 20% less so we can go back again. I mean, that's just not how things work when you're talking about the the mindset of business and the mindset of you know, objective financial decision making.
And then there becomes these arbitrary ceilings that people come up with, right? So it's like, well, 20,000 is now the ceiling that certainly it can't go above that, or whatever the flavor of the day is. It kind of almost reminds me of, Y2K in the year 2000, 20 years ago now, where certainly the world has had to end because it was the year 2000. So again, there's the human element, but then there's the informational element. They both come into play. Because as we see here, there's virtually no discernible difference whether you're at a market high versus if it's just any other previous level. What the data shows is that, more or less a very similar outcome looking forward 1 year. And then the same is true if we look out 3 years or if we look out 5 years, right? Not to get too lost in the weeds of the numbers and percentages, but the main takeaway here is that, as Kenny just said, just because we're at a new market high does not tell you anything about what will happen next, or certainly it wouldn't insinuate that it must go down because we're at a high.
Correct. And I mean, think about it in terms of, let me try to give you an analogy. It's like, Joe DiMaggio, I believe, has the longest hitting streak in professional baseball history, 56 games. You don't just start because Joe DiMaggio got a hit in his first 12 thinking, well, he's not going to get a hit in the next one. He's not going to, the next one's not good. That has nothing to do with what he did the day before. The market is always priced for positive expected return. If it wasn't, then no one would ever, when it wasn't priced for that return, why would you ever put your money in there? You expect to be rewarded for taking that risk. And that's where, I've said this a few times now, but our job is to help you make the best decisions regardless of the surrounding factors that you're hearing every day, whether it's on the news, whether you read Fox News or CNN, or you watch CNBC all day, trying to filter out this information to make what is mathematically the right decision to make. So it's just like, you don't change strategy, as an example, if you're sitting there and playing, you're playing blackjack, right? And the dealer shows a 10 and you have, you also have a 10. I don't play much, so I don't know. But if the strategy says to hit, you hit, because that is the best way to play the game. Now, does that mean that it might not work, right? And so the dealer may run into a 21 with 6 different cards. But if that happens again the next time the same situation occurs, you don't just change the strategy because that's not mathematically in your favor. You do what is objectively the best decision, making the best decision with the information that you have that is available to you. And that's why we take all that information, all the data that tells us our future higher expected returns, our future expected returns lower because the market's at a high. Our future expected returns lower because there's a Democrat in office or a Republican in office, or that there's an election year, or whatever have you, and filter all that information so that you make objectively the best decision. That doesn't mean it might not work, right? It could be best to, reminded of Austin Powers. We were talking about blackjack when he says, he gets a 6 and he says, I'll stay as well. And he says, because I too like to live dangerously. Well, obviously you need to get another card if you got a 6. So that, helping you make the smartest decisions.
Yeah, no, that's great. Great insight. Well, I think, no surprise, all 3 of these questions kind of go in together. So getting on to the third question that we're starting to hear more of, not surprisingly, is, hey, look, 2020 has been a heck of a ride so far. First COVID, now we're staring down the barrel of an upcoming election, which by all accounts will be just emotional as always. No matter which side of the aisle you stand on, that's really irrelevant. So the thought process, hey, I don't think it's a good time to be in the markets because based on what we've seen the first half of the year, I fully expect it to continue the second half. And so should I wait until after the election is over then to decide, how to get back in and how I should be invested? And Kenny, why don't you start off again with this one?
Yeah,
I think I know what you're going to say.
I might go on too long. No, I mean, I think it's just, first off, to me, really, the president of the United States is obviously a very powerful position, sets the stage from a policy standpoint, that trickles down to business. But the president does not get to determine whether the stock market's going to be good or bad. I mean, he really shouldn't get to take credit if it's good. It is not his fault if it's bad. And so I want to filter out the information and say, well, what does an election year tell you about stock market returns? And does it tell you something good, bad, and different? And let's try to figure it out. So going back to 1929, where you have reliable information about market prices, so you know if the market went up or down. We don't know in the election of 1861 with Lincoln's term whether or not the stock market went up or down. There really wasn't a market at that time, so there's no reliable information. But we do have information dating back to 29. And so 4 election years, has the stock market been negative in going back to 29. 1932, 1940, 2000, and 2008. And now let's look at each of those instances and say, well, was that because of the presidential election, or was it really unrelated and there's something bigger going on, right? And so let's think, 1932. Well, it was the Great Depression, right? So we're in the midst of the Great Depression, in fact, the heart of the Great Depression. I would think that had more to do with the market decline than the election. 1940. For those of you, not familiar with history, 1940 is, which I hope everybody is to a certain extent, it was right before World War II. They were bombing, the Germans were bombing Great Britain. They had already, invaded Poland. They were posturing, that's just in the European side. And then in the Asian side, Japan had already invaded China. You're looking at World War. So that's what happens in 1940. Was that more important to the market returns or the election? Most likely probably the beginning of a war that killed 50 million people. 2000, it was the dot-com boom. The boom had led up to. It's why the market was so great when Clinton was in office, because he was fortunate enough to be president when this technology boom occurred, and the money was moving in and out of these crazy companies that never made any money or never made any products or didn't do anything, and that all came crashing down right as George W. Bush was elected in 2000, and that's why the market was down in 2000. It wasn't the election of George W. Bush. It was the dot-coms blowing up. And then we've got 2008, right? 2008 was the culmination of the housing crisis, the second biggest recession since the Great Depression, had a lot more to do with the returns of the market in 2008 than the election between John McCain and Obama in those years. So that's just some data. And then Mark, when you talk about, kind of just this.
Yeah, I mean, it's impossible to argue against any of that because that's just what happened. I mean, the one thing that I would like to add on to it is that, when it comes to something such as politics, it is just human nature that we're so deeply rooted in our beliefs for the vast majority of people, especially in the polarized world that we live in today, that you just dig your heels in essentially, and you say, hey, if it's my candidate that ends up winning, then certainly only good things can happen as a result of that. And it's not possible that anything could go wrong or the stock market could tumble because it's my candidate. Conversely, well, if it's the other candidate who wins, who I don't like, then certainly they can't do well. It's just not possible because their policies are wrong, their beliefs are wrong, they're bad people, whatever the case may be. It's just that we dig our heels in and we, as part of human behavior, and really anchor even further into your pre-existing position of what your belief is, right? Right, wrong, or indifferent, red, blue, or any other color, doesn't really matter. But when it comes to investing, it's very challenging, but also very important to try to take those blinders off and look at things, as with everything else, as objectively as possible. And I think Kenny made a really good point earlier. It's that, hey, there's no one person that makes the stock market do any one thing, for better or worse. And if anything, I'm a believer in the idea that, politics on a local level is much more impactful than anything that's happening, in Washington. But even that doesn't necessarily move the stock market needle. I mean, yes, they can be impacted by one another, but they're certainly not directly correlated in any way.
Right. I mean, we just gave the examples. I mean, I'm looking at some, just gave the examples of these are the times the market was negative during election years. And if the market happens to be negative during this year, what do you think we're going to remember 50 years from now about 2020? The election, or possibly the fact there was a pandemic? I mean, I think we're going to probably be thinking it had more to do with the pandemic than the upcoming presidential election. And
Right.
So, I mean, Mark, I thought that was just perfectly said, right? Don't just put blinders on and think that how things will go based upon whatever you already believe. Because it's just not. An example, I can just look back. The best compounded return during the presidency of at least the recent presidents, Gerald Ford, 20.2%, right? Was up there, has the same compounded return as the current president, Trump, based upon his first 4 years. Jimmy Carter, compounded 6.1% based upon, I guess, recent information. You just don't know. It's not. It's is it maybe correlated? Right around the election time and who business thinks will be better. Is there going to be percentage points here or there that go? But no matter who wants, companies adjust. And in a society where essentially your job is to your shareholders to produce as much profit as you can, companies will make that happen no matter who is in office. That's just how it works. I mean, the example that I think of is World War II, right? Ford Motor Company. What did they start doing? They couldn't make cars anymore. They made tanks, right? They found a way to adjust and make money. And the same will happen again, with this election and the elections down the road. As long as we continue to, reward ingenuity and entrepreneurship, that's just what happens in a society like that. In society, the creative individuals are going to find ways to make their companies make money and make profit. Which ones those are is tough to determine, but that's just what is done.
Yeah, no, all great points there. So those are some of the questions that we've been getting lately. There's certainly other ones, and if you've got more, then shoot them our way, and we'd be happy to talk about them maybe on a future webinar or on our Bear Facts Friday, which comes out every week. We talk about the big picture perspective of that week. Unpacking the news is what Kenny does. I offer a little bit of perspective, and Lisa gives some wisdom. So all that's on our Bear Facts page on our website. And here again, if you have any other questions, shoot them our way. We're happy to talk about them with you and with our community at large here. So we appreciate everyone tuning in this week, and hope you all have a great rest of the week.
See ya.